Bond ratings are evaluations of a bond issuer's creditworthiness, provided by rating agencies like Standard & Poor's, S&P, Moody's, or Fitch. These ratings indicate the likelihood that the issuer, such as a corporation, municipality, or government, will repay the bond's principal and interest on time. Bond ratings help investors assess the risk associated with a bond and guide their investment decisions. Ratings are expressed in letter grades, with the highest being AAA or AAA for Moody's, indicating the highest level of credit quality and the lowest risk of default. Bonds rated below AAA but still investment grade include AA, A, and BBB, or equivalent. These ratings signify good credit quality, but may carry slightly higher risk compared to AAA bonds. For example, U.S. Treasury bonds, often rated AAA, are considered extremely safe investments due to the government's ability to meet its obligations. Bonds rated BB or lower are referred to as junk bonds or high-yield bonds. These have a higher risk of default, but offer higher interest rates to compensate investors for taking on greater risk. For example, a startup issuing bonds might receive a BB rating, signaling higher uncertainty but the potential for higher returns if the company succeeds. The rating agencies assign these grades based on various factors, including the issuer's financial health, revenue stability, economic conditions, and management quality. For instance, a well-established company with consistent earnings and low debt is more likely to receive an investment-grade rating than a new company with unpredictable revenues. Bond ratings directly impact the bond's cost to the issuer. Higher-rated bonds, like AAA, have lower interest rates because investors view them as less risky. Conversely, lower-rated bonds must offer higher interest rates to attract investors, increasing borrowing costs for the issuer. For example, a company with a BBB rating might issue bonds at a 5% interest rate, while a company with a BB rating might need to offer 7% or more to secure buyers. For investors, bond ratings provide a quick way to gauge risk. Conservative investors might stick to investment-grade bonds to prioritize safety, while those seeking higher returns might consider junk bonds, accepting the added risk. Ratings also help in portfolio diversification by allowing investors to balance risk across different types of bonds. It's important to note that ratings are not guarantees. They reflect the agency's opinion based on current information and can change if an issuer's financial situation improves or deteriorates. For instance, a bond rated A might be downgraded to BBB if the issuer faces financial challenges. In summary, bond ratings are credit scores for bonds, indicating the issuer's ability to repay its debt. They range from high-grade AAA to speculative junk bonds, helping investors balance risk and return. While useful, ratings should be considered alongside other factors for a complete picture of a bond's investment potential.